Good afternoon, everybody. Welcome to another Moving Markets podcast. My name is Jeffrey Dunyan, owner and founder of Safe Option Strategies. I'm your host for the podcast today. Usually I have with me Kevin Hurley, the owner and founder of Hurley Investments, LLC. Kevin's unable to make it today, so for the second week in a row, I'm flying solo here. Hopefully I'll have Kevin back next week and his schedule will ease a little bit. He's had a lot going on in the market. He's making sure he gives his attention and his time to his clients, and so he cannot join me today. Three main things I want to talk about today. We're going to talk about the Fed meeting on Wednesday. I'm going to save that for last. I'm going to talk a little bit about the importance of what the Fed does and what the Fed says when Wednesday rolls around. The first thing I want to talk about is First Republic Bank and what went on over the weekend and how that might affect your portfolio going forward and some things to be watching out for. And then, of course, we've got to talk about some earnings news. There's a lot going on this week. Last week was a big, huge week for the tech industry with earnings. A little more going on this week, and the big technology companies kind of wrap things up this week, or mostly wrap things up this week with Apple's earnings that are coming up on Thursday. So let's talk a little bit about First Republic Bank. Let's talk a little bit about the earnings. Let's talk about the Fed meeting on Wednesday. So if you got up early this morning, you were watching futures, watching the market, you saw the big news that JP Morgan Chase bought in some type of bidding process First Republic Bank. First Republic Bank is the second large bank. They call it a regional bank, but it's a pretty good sized bank. And it's the second one to go under following the collapse of Silicon Valley Bank. It's a lot of the same issues that caused problems with First Republic Bank that happened with Silicon Valley Bank. And what it comes down to, I believe, is really two or three things. I'm going to tell you three things primarily that has caused the collapse of these banks. Number one is that these banks were incredibly poorly managed in the sense of where they put their money. When you deposit, some people don't know this. I'm going to give you just a little simple lesson. And I'm not a bank expert. I'm a little simple lesson here about what happens to your money when it's with a bank. I'm not going to try and if anybody's a banker out there and you want to email me or get online somehow and scold me a little bit for not getting this exactly right. Here's kind of my understanding of what goes on in a bank. I go down and I make a deposit in a bank. I open a checking account. I open a savings account. My business account, the bank I'm with, I go down there. I put $30,000, $40,000 in the bank. I have any of the sales, any of the revenue from my business goes into that bank account. Of course, my expenses come out of it. I might have some of it in checking and some of it in savings. To me, it all feels very liquid. It feels like when I want money, I can pull money out. At the bank, it's not exactly like that. There's a certain amount of cash and a certain amount of money that they have at the bank. And then everything else goes to a central bank. Way more money than what the bank has on hand is what the bank has on their books in the way of deposits and savings accounts and reserves. So let's just, for real simple, even numbers, let's say a bank had $1 billion worth of deposits in that bank, a combination of the balance people keep in their checking accounts, their savings accounts, maybe some money market accounts, and some different basic, simple investment vehicles. Let's say the bank has $10 billion parked there. No way the bank is going to have $10 million in cash on hand at the bank. The majority of that money, or at least a good portion of that money, goes into investments. It may go into short-term bonds. It may go into long-term bonds. It may go into real estate holdings. The bank is loaning money to people that are buying houses. They're loaning money to people that are buying cars. That money is out there to the builder of that home. That money is out there to the buyer of that home. That money is out there as an investment. And of course, those things get interest charged on them, or they make money. And that's how the bank profits. The bank profits a little bit by the fees they charge everybody to make a cash withdrawal, to do, certain accounts. You pay a fee if the account balance goes under a certain amount of money. And a lot of the money that the bank has on paper is out working for the bank. It's out there in other investments. And there's no way, if everybody that had money at that bank decided on the same day to withdraw their money, the bank would be deeply, deeply in the hole. They would be in big trouble. And that's what's referred to as a run on the bank, when too many people get nervous and start pulling their money out of those investments, or pulling their money out of their savings, pulling their money out of their checking, reducing those balances. And then suddenly the bank, all the money is out there in investments, and there's not enough cash to take care of the customers that are pulling money out, and it can create a tough situation. Well, First Republic Bank and Silicon Valley Bank, both of them put way too much money into long-term bonds, bonds that don't mature for 10 or 20 years. They're a guaranteed interest rate, they're a guaranteed rate of return. But the problem is, if rates begin if the bond yield begins to go down too far, the bank can find themselves in a negative situation. They can lose the confidence of their clients, their investors, and people do make a run on the bank. It's not like the old days of Mary Poppins, when Mr. Banks had everybody come running into the bank and they all wanted to withdraw their cash. This is all done electronically. It's me going into the bank and transferring all the money out of my savings account into a checking account in a different bank, or it's running to the ATM if I've got a balance that will let me, let's say I could withdraw $500 a day at the bank. Maybe 3 days in a row, I go to the bank and take out $500 so that my family checking account is empty or something like that. It's done electronically, but it's the same principle. There's a run on the bank. People pull their money out. The bank is in trouble. Also, if these banks are public, like SVB and First Republic were, if they're a publicly traded company, then they've also got stock that's issued to people. And if too many people start selling the stock and it drives the price of the stock down, the stock that the bank themselves is still holding becomes worth less and less and less and less, and the value of the bank goes way down, and they're in big trouble. So the first thing that created this problem was the too much money in long-term bonds. Now, in the case of Silicon Valley Bank, they also had a lot of money loaned out to venture capitalists, people trying to start up a company, people trying to expand a young company. And that's a little bit of a gamble. If you get a little too free and a little bit too loose with how much money you loan to people trying to start up companies, most companies fail in the first 2 or 3 years. And if you loan money to 10 different startup companies, and you know that statistically 8 or 9 of them are going to fail, you got to hope that one that doesn't fail makes you so much money and you get such a return on that it takes care of the losses you pick up on those other 8 or 9 companies that you invested in. At least in the case of Silicon Valley Bank, they had way too much of their balance sheet, the money that they had, too big a percentage of it was involved in venture capitalism. And the market's been tough for that the last couple of years. The Biden economy, and I'm calling it the Biden economy. If I upset half the country a third of the country who thinks Joe Biden is doing a good job, so be it. He's doing a horrible job in terms of our country's economy, and he's created a very, very difficult scenario, an environment for small businesses to get off the ground. And so maybe a higher percentage of those than normal are failing, and it put SVB in a really, really difficult situation. First Republic Bank was similar. I don't know if they had as big a portion of their balance sheet into venture capitalist situations, but they did have way too big a portion of their balance sheet was in longer term bonds. So the reason this is relevant, the reason we're talking about this, JP Morgan stepped in and basically bailed out the people invested at First Republic Bank. Most of those people, because of the size and the wealth of JP Morgan as a company, most of those people that had investments there are probably going to do okay. They're probably going to get their money back, or at least not lose significant portions of their money. The Fed, the Treasury, has gotten overly involved, with Janet Yellen saying, hey, we're going to, at least in the case of SVB, we're going to bail out everybody. We're going to federally insure everything, even those deposits that are above $250,000. FDIC insurance, which, banks love to have that stamp on them that they're FDIC federally insured. That's supposed to protect the first $250,000 of what you have with a bank. Anything above that is exposed to the risk of what the bank does. Well, in the case of SVB, Janet Yellen stepped in and said, "Hey, we're gonna bail out everybody, even those that have more than $250,000, and we're going to do this for some other banks that look like they're going to go under, but we may not do it for all banks." Um, there is worry amongst some of the top financial minds in this country. Jamie Dimon, the head of J.P. Morgan Chase, being one of them. What's his name? Charlie Munger, who is not as well known, but is basically the business partner with Warren Buffett and helps run Berkshire Hathaway. Charlie Munger says there's a lot more pain that's going to be felt and worse things to come. There are a lot of people that think that SVB and First Republic may just be the first two dominoes to fall, and that's going to create a much less stable situation. And then what happens is bigger banks, Chase Bank, U.S. Bank, Wells Fargo Bank, Bank of America, banks that are much bigger, that are more secure, that have smarter people running the portfolios, they're likely going to be okay, because that's where a lot of people are going to move their money to, because they're more diversified. They're spread out more evenly. They're not overloaded in long-term bonds, and they're not overloaded in venture capitalists. They're more diversified in a variety of different things. So if one of those particular markets is going bad, there are others that are likely going good. So that's where people are going to move their money, and for the most part, people in those banks are going to be okay. But there's a lot of ripple effect and a lot of repercussions that can be had with smaller, more regional, localized banks, as one domino tips the next and tips the next. So there's some concern about that. The one thing I forgot to mention, I told you there were three things that I think were the downfall of these two banks, at least in the case of Silicon Valley Bank. You've got some bank managers that are honestly more concerned and more worried about equity, diversity, inclusion. They're more worried about woke virtue signaling. They're more worried about LGBTQ issues, transgender issues. They're more concerned with that and spending more money on that than they're spending analyzing markets and making wise financial decisions for their clients. And again, at the risk of alienating a third to a half the country politically, I honestly don't care too much about that. And I'm not trying to make it political. I'm just telling you, corporations like this, banks like this, have no business getting involved politically like that. You shouldn't make investments with people's money based on what gender, what race a person is, how they identify. Check that stuff at the door of your bank. Go into a bank, deposit your money, and you ought to be able to have some confidence that the people at that bank are just going to make wise financial decisions, period. End of story. When a bank like SVB is spending $1 billion on LGBTQ initiatives during the year, and it's occupying who knows how much of the time of the individual that's supposed to be balancing their portfolio and managing where the money goes, I personally feel like there should be a lot of liability with that individual, and people should pull their money out of banks like that and ask them to just quit messing around with this politically correct woke nonsense and focus on making money for your clients. That should be the only responsibility of the bank, is protecting your money and making money for the shareholders. So that's the things that took down SVB and Silicon Valley Bank and First Republic Bank. And luckily, JP Morgan was willing to be a part of the bidding process and step in and bail things out there, and we'll see how it turns around. So interesting happenings with that. Let's shift gears and talk a little bit about earnings. There are a number of important earnings reports coming up here in this upcoming week. I like to use earningswhisper.com as a nice, easy to navigate calendar. I'm not sponsored by Earnings Whisper. I'm just going to put a plug in for them here. They've got a good website. It's well organized. It's easy to look up information that you want. It's my go-to source for all things related to the earnings season and corporate earnings. As it relates specifically to earnings this week, there's several that I'm looking at very, very closely, and not necessarily close to, but not maybe exactly in the order that they report in. I'm looking at AMD and Ford after the market tomorrow. And those two companies are more closely tied than most people realize. The auto industry has had a couple of years, 2-3 years in a row, where they've been relatively backed up on orders. They've had a hard time keeping up with demand and producing enough new cars. And a lot of that has been due to a chip shortage. Last year, there were reports of people buying cars that did not have all the computer chips in the car that were supposed to be there. And as a result of that, people were buying the car and then having to go back to the dealership once those chips came in and have those chips installed, which, wasn't costing people any extra, but it's an inconvenience to say the least. And so you had a little bit of that going on. And so the chip manufacturing sector has been very closely tied to the automobile sector. So you got these two companies, AMD and Ford, that both report after the market closes tomorrow, and expectations are high for both of them. People want to hear some good information. People want to hear from AMD that they're back on track, that they have a plan to keep up with demand, that they have a plan to fill all the orders that they have and not be as far behind. If they can report something like that, that stock could absolutely surge. It was less than a month ago, AMD was trading a little, just fractionally over $100 a share. It got up to $102 a share and then backed off one day in March and finished just above $100 a share. And then it's kind of had a steady slide down to about $85 a share. A couple of days of rally recently, and it's back up to almost $90 a share. I think on an earnings beat, they're going to be back up to $100 a share within a few weeks. I think on an earnings miss, they may break right down through 84, 85, which is kind of set up as some recent support, and be right down to the next level of support, which is around $76 a share. So I think you could see some really big movement from AMD, whatever their report is. If they kind of thread the needle, come in at expectations, but don't guide real well, they could flatten out a little bit, but I don't see that happening. They're either going to beat expectations and guide well, or they're going to miss expectations and express some worry about future guidance, and they're going to tank. So I'm looking for one of the two or the other. Ford's a tougher one to dissect for me. When it comes to Ford, they have been in a range now for the better part of 4 months, between around $11.50 on the low side and up around $13 on the high side. There's been a couple of times they've poked just a little bit above or a little bit below that range, but there's been a lot of back and forth on Ford. If you're a technical trader at all, technical crossovers have come, reversing the trend from bullish to bearish. 1, 2, 3, 4, 5. I'm counting 5, almost 6 times just in the last 4 months. A lot of people, myself included, I'm heavily invested in Ford, full disclosure. A lot of people, myself included, would love to see Ford go back up to $24, $25, $26 a share. And I think they're capable of doing that. I think they need to maybe back off a little bit, not back away from, but back off a little bit on the aggressiveness of the EV push. I'm not saying they shouldn't be in that market and shouldn't be moving forward in that market, but Ford should keep their focus on what makes them the most amount of money, and that is the F-150. And I'm not talking about the F-150 Lightning. I'm talking about the F-150. I'm talking about the gas guzzler that is the most popular selling truck for multiple decades in a row. And if they'll keep their focus there and talk about that a little bit, that'll be a good thing. If they complain about their EV market, now there's going to be a little bit of pressure as it relates to the EV market. If they complain about the EV market, if they talk about things not doing as well as they should there's going to be some trouble for Ford, and they could be a sub $10 a share stock within a few days of earnings. It was less than 6 months ago that they went down and touched $10.10 a share or close to it. They've managed to stay above that ever since then, but they could be back down testing that number pretty easily and pretty quickly. A couple of other earnings of note this week. Uber reports this week. Pfizer reports this week. I'm watching those two closely as well. Pfizer tomorrow, Uber also tomorrow. Tomorrow's a big day for earnings. And then Thursday, I'm excited about Apple's report on Thursday. Apple has had a pretty strong bullish run. They continue to be a well-performing company. Apple has gone, if you haven't been paying attention, Apple has gone from $126 to $170 a share in the last 4 months. If you want, let me get my calculator and make sure I give you an accurate number. $170 minus the $126 is $44 divided by the $126. Apple's up 35, almost 35%. They got above 70 briefly today, finished just below it. Or excuse me, 170. They got above 170 briefly today, finished just below it. But that's a 35% gain in 3 months. That is a phenomenal move up by Apple. And like with some of the other tech companies that are reported recently, I'm talking about Meta, I'm talking about Amazon, I'm talking about Microsoft. They've reported and they've either had some really big up movements or some really big down movements. I think Apple's kind of in that same boat. Hard to gauge how much farther Apple will go up if they have a really good report, because building on a 35% return over the last 4 months is not the easiest thing in the world to do. But if Apple really hits a home run, who's to say how far up they can go? They could hit 180, 190 in a day or two, and that's not even a giant percentage move. If Apple's going to have a really big miss to tumble too much. They could have a little bit of a miss, and maybe they come back down and test a support line around $160 a share. That's not real strong support, but there's an argument to be made for a support line around 160. You could see Apple doing that, but I don't think they'd tumble much below that, even if they do have an earnings miss when they report. Let's see. I think there's other companies obviously reporting. British Petroleum reports tomorrow. An oil stock that's worth keeping an eye on. There's a number of other big companies that report, but those are the ones that I'm most interested in, and we'll see what they do in the way of potentially moving the market up or down. Now, the last thing we got to talk about is the Fed. We talk about this every week. It's been the biggest story of the last couple of years, because when the Fed started raising rates, they did those 75 basis point rates a number of months in a row. They backed it off to 50 basis points one time when they met. They backed it off to 25 basis points, I think, the last 2 times they met. And there's a 93% probability that when they announce what they're doing on Wednesday, they're going to go up another 25 basis points. I think that's baked into the market already. I don't think anybody cares that the Fed is going to do another 25 basis points on Wednesday. Everyone that pays attention to the markets is going to be listening for whether or not the Fed says outright or hints strongly towards a pause after this rate increase. Most people are anticipating that. Most people that consider themselves experts are anticipating that there will be a pause after this rate increase. Problem is, well over 70% of all the analysts that are interviewed have been saying that since December of last year. And every single time they have said there will be a pause after the next upcoming rate hike, they have been wrong. A lot of them have been wrong on the next upcoming rate hike. Back in December, a number of people that I listen to and follow said that there would be no rate hike in January, and that the Fed might even reverse and start lowering rates by March. And they were dead flat wrong. A lot of people have been saying this next one will be the last one. This next one will be the last one. But they've been doing that for the last 3, 4, or 5 rate hikes. And core PCE, the report that we got last Friday, showed that with the core meaning the most widely purchased staple goods that people buy, inflation was up year over year 5.6%. The Fed is trying to get inflation down to 2%. They've got a long ways still to go. And the notion that they're going to pause, I'm not in that camp of most people that think they're going to make a pause. In fact, I'm pretty firmly of the opinion that the Fed is going to raise rates 25 basis points on Wednesday, and I believe they are either going to repeat what they've said multiple times they've met in a row, and that is, we're going to continue to analyze the data and we're going to continue the job until inflation is down where we want it, which is a signal. That's their way of saying we're not done yet. They might even come right out and say we're not done yet. I think they will either do that or they'll be incredibly ambiguous and not give away anything about an increase or a pause. And if that's what if that's what we get on Wednesday, if we get a 25 basis point hike and no strong indication or the Fed, Jerome Powell outright saying that they're going to pause, I think the markets are going to react very negatively to that. I think you're going to see a big sell-off at the end of the week. It may not come much on Wednesday after the announcement because you'll have a lot of people trying to dissect the information on Wednesday. I think Thursday and Friday could be big major sell-off days in the market if the Fed doesn't say pretty definitively or hint incredibly strongly towards a pause after this rate increase. They've got a very, very difficult needle to thread right now. They've got to, and if they do have a pause, they've got to have some commentary about not being too worried about the bank collapses of SVB and First Republic, because a lot of people think that a pause would only come because of the bank crisis situation. And it almost paints a picture that the situation is worse than people thought because of the pause. In other words, the pause would be good for the markets, but it could also be bad if people interpret that as this bank situation is much worse than we thought. So it's going to be exciting. Next week at this time when we do the podcast, we're going to have a lot to talk about in terms of what happened with these earnings reports, whether or not we hear about any other banks that are in trouble, and how the market reacted specifically on Thursday and Friday to the Fed. I think tomorrow is going to be a pretty soft day in the market. I think it'll be something of a repeat of today. The three major averages, none of the three of them moved more than 0.15%. That's a pretty tame day in the market. So not a lot of big action in today's stock market. I think tomorrow is probably going to be a little bit of the same. And then Wednesday, after that Fed announcement around 2 o'clock Eastern time, you're going to see things move pretty big one way or the other. So those are the things that we think are going to be moving markets the rest of this week. Thank you for joining us. If you have a chance, check out my website and the education we teach about safely trading in the stock markets at sostrades.com. Safe Option Strategies is the company that I have owned and operated for close to 20 years now, teaching people how to navigate the stock market in difficult times and do it in a very conservative, very safe approach. You can learn a lot about how to make money regardless of what the market conditions are. Check us out at sostrades.com. And in the meantime, everybody have a great week, and we'll follow up and see if anything we talked about happened the way we wanted it to or the way we thought it would when we visit with you next week. Bye, everyone.